to be here back again at the IVCA annual summit to talk about what investing and the investment climate looks like. We've got a great bunch of people here. I'm going to time them appropriately so that we can get more of a conversation going. We are going to link the macros with the micros as well and talk about each of their businesses individually, as well as the kind of dry powder that they're sitting on and what they intend to do. Why are we talking about buyouts? Because buyouts have been part of the investment strategy for men like we have here on the panel over the last several years. In fact, over the past decade or so, we've seen an increase in the number of buyouts. And, 2022 was a record year, and we've started to see an improvement after a little bit of a lull. We've started to see an improvement in 2024. The sectors that we are seeing controlled deals or buyouts happening in: IT, ITES, healthcare, manufacturing, retail. There's a whole bunch of them. But the outlook continues to look strong at this point in time. So without further ado, Manish, Kejriwal, I'm going to get you to start with the macros. As we look at 2025, let's first talk about the global trends that could shape investment strategies in India. Your time starts now.
Thanks, Shereen. Great to be here. Good seeing you again. I think a month ago when we were all in the Alps, the two themes or two topics people talk about was Trump and AI. And I'm just saying that because I think while that's not an investing theme, what the two of those things happen will really influence a lot of the global investors going forward. I think going back to global trends, if you look at it from the perspective of GPs, it's been an interesting year, 23 and 24. I think the biggest takeaway, if we went back to the Investor Council that we had a month ago, was a real lack of DPI and money going. So there was a significant shortage of liquidity, money being returned by GPs to their LPs, which is not good news, given the state of the markets. And because of that, a lesser degree of investment by global LPs into the asset class because there was a lack of liquidity. I think India is in a very different place. I think we're in a secular uptrend, barring the early stage VC when there was a slowdown given what happened 2 years ago. I think we'll see that come back. But if you see this as a representation of the dry powder, even all of us, despite being price disciplined, are stepping up and paying and acquiring assets where we have a high degree of conviction. But the bar is that much higher. And what's helping us is the DPI story out of India, which was a disaster 15 years ago, is today the one thing which is most appealing, not only vis-a-vis the rest of Asia, but as far as the rest of the world. Because
Why?
We have, exactly, booming IPO markets, which has been actually the exit from the majority of all our positions. But in addition to that, a significant amount of dry capital, as we said earlier, for sponsors. And India being globally relevant, whether it's China plus one, given what's happening to the Ukraine and the Middle East, it seems like even the strategics are refocusing on India. So exits, IPOs, of course, but in addition to that, the financial sponsors, because of all the dry powder we have and because we believe in India, and in addition to that, the strategics. So as a promoter or a GP which controls an asset, our exit options for the first time are multiple and very attractive.
Multiple and very attractive. And I think that has been the change as far as the story is concerned. And we've seen that accelerate, especially in the last few years. Vivek, let me come to you to draw the macros and the micros. And let me start by asking you about the global outlook first before we talk about India specifically. To take forward what we heard there from Manish, what will be the trends that could potentially shape investment decisions and investment strategies globally, which could have an impact and a bearing on India?
What happens in the US matters for what happens in India, right? And I think there are probably three things I'd highlight. Number one, if you just look at where buyouts have gone in India, there's been increasing concentration from about 55% to 75% into three sectors: financial services, IT, BPO, and healthcare. And we suspect that will actually only continue to increase for very important reasons. These are often family-owned. They're often available for sale. You're effectively buying out other people's equity and capital. They often don't require cash, as much cash for growth, other than M&A and platform opportunities. So that's one trend that we definitely see persisting, is companies who produce great cash, whose balance sheet can be well managed, and whose equity stakes are available for sale. Those three sectors offer a lot. The second is, we actually do believe that the risk-reward returns for buyouts, and all the LPs do understand this, risk-reward has really favored buyouts over the last cycle.
Okay.
What you'll find is, if you look at large growth, large buyout, small buyout, pipes, and other forms of, effectively what you'll find is that on a risk-adjusted basis, buyouts are outperforming. And it's fundamentally, our belief is because buyouts help you reduce beta in many specific ways, not just how you allocate, not just governance and how you allocate capital, but it also allows you to control exit timing. The third trend, and this is where the US, by the way, people are nervous in the US about this, and in India, hopefully the party will continue, is if you look at buyout specifically and the MOICs, right, on exit, buyout, just other sales to sponsors for buyout companies delivered about a 2.8 MOIC. Sale to public markets at the time of IPO, 5.1. And sale to public markets a year following, 4.8. In other words, a huge amount of the outperformance of buyouts has been route to exit, and that is dependent on how buoyant the capital markets stay. And that's something actually in the US, which has actually been a little more muted.
Yeah.
So as long as the IPO market stays open, we should continue to see great exits.
Deepak, let me understand from you, your plans on how you see the global environment and what that could potentially mean in India. I know that you believe that you've only just gotten started in India. This is a landscape that is ripe with opportunities and possibilities. Take me through what the India story to you means today.
So let's start with the global allocation, right? So broadly, global allocation, there would be a bias towards US. There would continue to be a bias towards US. There is a lot of volatility associated with US, but that's a market that would continue to outperform. Focusing on India, I mean, this is our core market in Asia. We have a multi-asset class view here: infrastructure, private equity, late-stage growth. And I think infrastructure has started to mature for us a little bit. Private equity and late-stage growth have only just started. I mean, a lot of people, when they look at us, they look at broad pool of capital, but what they don't understand is a really large GP. Almost 80% of our assets are managed in-house, especially in India. Last 9 transactions that we have done have all been direct. That doesn't mean we don't partner with our partners like Dara. We continue to do that, and that creates a right to win. But continuing on across the 3 sectors: IT services, financial services, healthcare. Healthcare, the journey is only started, right? Like he's talking about like being a second largest chain, but the reality is in India, corporate chains are still 12%. So corporate and regional chains like Sahyadri, which we own, are only 12% of overall hospital beds. So it's a multi-decade consolidation journey, and there are several such multi-decadal journeys that are existing in India that we'd continue to focus on, drive, and move forward.
But Sumeet, let me come to you now and talk about your journey here, specifically from a buyout perspective. How do you see India? What's the outlook for 2025? Do you expect 2025 to be a significant accelerator over the previous year? What's driving the needle today?
Yes, so I think as a firm, we focus on mid-market buyouts, buying businesses which are usually $5 to $30 million in EBITDA and less than $300 million in enterprise value. I would say over a 10-year period, the supply of businesses that are available for sale has exponentially increased for multiple factors.
Right.
Being succession planning, spin-offs, global firms looking at partnerships in India. And also, there are 2 key themes I think that we have worked on. One is the global partnership model. I think a lot of Fortune 500 companies, to succeed in India, sometimes appreciate having a local partner, and we have done it 3 times over with Iron Mountain, Yum Brands, and Amazon. And the other theme, which is a very proven playbook in US and Europe, is consolidation of fragmented industries, where industries are fragmented, but each player makes money because the industry structure is very disciplined. And there with scale, I think margin improvement to growth to upgrading management and and eventually multiple expansion all plays out. So we have done that 8 times over. So I think that theme of lot of industries in India are still fragmented. I think that consolidation play opportunity will continue. And with public markets getting little subdued compared to 24, I think there is a pool of businesses and shareholders which are looking for liquidity. So deal flow, I think in the next 12, 18 months should accelerate if public markets stay the way they are as of now.
The themes that I'm picking up from each one of you in your initial comments, one, of course, is family-owned businesses looking at ways of exiting at this point in time. The next generation perhaps doesn't want to be, doesn't necessarily want to get their hands dirty, wants a way out. Consolidation and, fragmented sectors being put together. That's another theme that seems to be playing out. Global companies looking at India from a local strategic perspective. That's the other theme that's playing out at this point in time. If I would ask you about valuations, because that oftentimes is the impediment, is this a buyer's market today? I mean, you've been cautious about this. Are we looking at deal flows from a buyer's market perspective?
Shereen, I think if you look at what was clear is the time gone by. So I look at 24, it was definitely a seller's market. We had IPO markets which were crazy. We all got exits. I think each one of us, we had more than 4 IPOs. We still have another 3 in the... It's gotten tighter now. So when it's a seller's market, buying was very difficult last year. So, of course, each of us has teams that are motivated by making new investments and exits, but the focus was on driving exits, cash, and DPI. Of course, our teams, I mean, deals don't happen overnight, as you know. It takes years to get a deal done. I would say we did do 2 or 3 deals last year. We normally would do 5 or 6. So the rate of deployment slowed down.
Do you believe that it's likely to slow down further or pick up?
Yeah, so my sense going in the past was, despite that, we did stuff, you had huge conviction. So you pay a higher price, the amount of margin for error goes to 0 or close to 0. So your level of conviction, you spend a bit more time. I think going forward, what this has done is, and I would say definitely for us, I would guess Mukesh and of course, OTPP and our other friends with Sumeet, our pipelines are extremely strong, right? So we have 20 things in the hopper, which we've been working for more than a year. I do think the public markets eventually are an indicator where the private markets are going to go. And it hasn't been the most healthy start to a year. I think prices rightly will correct, the multiples will compress, and the second half of 25 will be a buyer's market much more than a seller's market.
Okay, so Mukesh, let me understand from you, how are valuations looking at this point in time? Are you also holding back or sitting on the fence, waiting for things to turn as far as valuations are concerned?
I think if you look at India's valuation, on the large cap side, in fact, we are below long-term averages. So on large cap side, it's fine, but I think the frenzy which happened in the mid cap and small cap, primarily driven by large domestic inflows. Our biggest competition actually for deals was public markets. It was not other PE firms, because we do only buyouts, and when we see the founders having a valuation which is 2x of what we are offering in the IPO market, it was very difficult to convince them. But off late, I think what is going to happen is supply is going to outstrip demand. And the supply of capital also in form of number of IPOs which are coming, and with this correction, I think I agree with Manish that second half is when, a lot of people who are looking, I know some of the IPOs have been pulled back. So it will not be as easy to do an IPO as it was earlier, and that was when...
pulled back on account of the volatility that we're seeing?
Volatility and I think the valuation what they had in mind.
The expectations, the mismatch in expectations between what the founders expect and what the market's willing to offer at this point in time.
Yes.
Sumeet, are you seeing that as well? Do you expect things to pick up in 25? And do you also believe that this mismatch of valuation expectations is perhaps going to see more IPOs fall or being a casualty to this misalignment on expectations?
So I think if you see globally, as investors sitting globally, still India is, I think, on the expensive side on a relative basis, what they are seeing. So I think the markets will be subdued. And I think to each seller, if people like, even in our business, if a business needs to be sold and we need liquidity, and we're getting 10% lower than what we want, we would go ahead and do it. And I see the same behavior from, other motivated sellers and buyers respectively. But I think it will be a little subdued environment seeking liquidity.
Vivek?
India's pricey. We know India's pricey. I think there are 3 lessons we've taken from it, just observing outside in, right? One is India's equity risk premiums is now getting back to a high, thanks to currency depreciation, thanks to other risks associated with it. And as a result of that, it's actually quite difficult to, even with buyouts, you need a 2 in front of your returns. You need a 2 in front of your returns, and anyone going out there raising capital who says otherwise is probably, is tricking themselves. LPs will tell you, you need a 2 in front of your returns to justify the prices at which you're buying. So that's one. The second is, look, we went from a regime of, paying 4 to 6 times, 8 to 10 times. Now we're paying 12 to 14 times. Guys, we know what we're buying at. And therefore, what has happened as a result of that is people are moving to quality. You're better off buying a platform of higher quality at a slightly few more turns multiple that can use the thesis that Sumeet talked about or Mukesh talked about as a platform to acquire other businesses, as Care Hospital has, or some of the other examples, versus buying a fixer-upper at a great price. So this is not a market where you really want to end up buying a fixer-upper.
What does the pipeline look like? And I'll get each one of you. Do we have more fixer-uppers at this point in time, or do we have the high-valued quality bets? Mukesh, you want to come in on that?
For us, what we thrive is, what we state to our LPs also, we look for deal complexity with great businesses. That's what we
Deal
thrive.
complexity with great businesses,
Yes.
okay.
Where there's a motivated seller, where there's a cross-border transaction. We bought VFS when there was COVID. We bought Care Hospital where there was a minus frivolous case going on. IGI where Fosun was the seller. So I think in those situations, as Sumeet also rightly said, there's no option but you have to exit, right? And that's where we come in and move at speed and certainty to get this business in our favor. So, and if we see that we can create value, whether you pay, any deal, if you pay 10-15% higher, but if you have the conviction to create value, I think if you have to go wrong, you will go wrong even with the 10% lower value. So I think what we thrive for is deal complexity, and when we see that, we move at speed.
But let's address that value question and the value issue then. I mean, what are we talking about in terms of the kind of value that you hope to create, say, over the next 5 to 7 years? The returns that Vivek was talking about, that Sumeet was talking about. I mean, what should we realistically expect now in terms of value creation as well as return generation from an Indian asset?
I think our value creation journey will remain the same. Like Emphasis was declining 20 quarters in a row. If I would have bought Emphasis even 10-15% higher or 20% higher, we would have made the, what returns we have made. And I think we got, in terms of IT services alone, we have got more than 50 clients from Blackstone portfolio. So I think whether that will stop, no, that will continue going forward. In Care Hospital, to Sumit's point, what you've done in insurance brokerage, we've done in hospitals. Again, you've created a platform. If you buy 10-15% higher, but the other platforms which you're, adding on to it, I think that will continue. And to Manish's point, after some point where you see the margin of error is too low for all right bets to go right, that's where you put a pause and say, let's wait and watch.
So it's not a pause for you at this point in time?
Not a pause for us. So I think personally, as I stated, IPO is a good way to start, but that's, it's not a good way to exit, right, finally. And especially for promoters of Indian companies, for markets have become quite matured enough for PE firms to exit completely in public market. But for founders, if they have to sell a controlling stake, it becomes very difficult to exit in public market. So at right point, I think this will move again towards private market. And for us, certainly, we see opportunities going forward.
So this is a man with a listed company with lots of money to deploy. So all families in this room should be coming to him, and Mukesh is the man of the hour.
Let me get closing comments from each one of you, because I think we're pretty much at the end of our time. As we look at the India story, and I think everybody's talked about the opportunities that present themselves, how exciting it's looking, what it means in terms of a return perspective, etc. What does the India premium today look like? Mukesh, let me start by asking you.
I go to LPs and every time they say India is trading at it's trading at 100% premium to UK market. It trades at 20 times P, UK market trades at 10, and they give example of China and they give examples of Korea, etc., which all trade at 10 times P. And my answer is, if you look at returns of India for the last 30 years, 20 years, 10 years, globally, all the markets, just take the returns of all the markets for 30 years, 20 years, 10 years. India, there are only two markets who have delivered double-digit returns globally, US and India. And all the other markets are low single digits. So even if you correct India by 15%, 20%, it will still outperform all the peers. So I think one great thing about India is the reason why the multiple is also high is the growth which this country exhibits and the stability of the government and the spirit of Indian entrepreneurs to even work in difficult environments and create value. Obviously in mid-cap and small-cap there has been a huge spike and there has been a correction, but I think the growth will continue and India will continue to trade at premium to other global markets given the growth it has.
Manish?
I think Mukesh has answered it well. My point is, when someone talks about the India premium, we should always, as we do with the LPs, remind them of the India growth. I mean, when you talk about a 6 or 7% terminal value in your models, people are shocked. I mean, how do you do that? So it needs a higher. I think the more important aspect is not everybody has made money in India, right? So at the end of the day, to Mukesh's point, I think you've got to trust the GP that you're deploying capital behind. It's not about riding the beta, it's how do you drive the alpha. Whether, as Vivek said, it's driven by operating partners, there's an angle which has to be related. At the end of the day, this is a people business. You've got to get a bunch of guys who know you can differentiate, because otherwise everybody should be giving supernatural returns. So what I'm saying is, in a market like India, which is not cheap, there's a reason at the macro level why it's not cheap. But in order to really make money at a consistent level is very difficult. And I think one of the core aspects, which I think is bimodal, is what Deepak said earlier about the governance. So the only thing, we may or may not have made a lot of money, we luckily have. The one issue I take pride in is we haven't called a promoter wrong. We've never had a situation of theft or we've been very, that I think is critical. And I think given where markets are, people are also realizing it's better to show the extra $10 on your P&L rather than taking out somewhere.
No, I think the governance premium, that point is well taken. Sumeet, the India premium?
So I think on a normalized basis, I'm not taking a static view of a particular quarter. On a normalized basis, I think it has sustained over the last 20, 30 years. I think on fundamental NPV Excel sheet basis, I think it is justified. Second, I think it's the same Fidelity Wellington investor sitting in, overseas buying Suzuki stock in Japan and Maruti Suzuki in India. So it's the same buyer who's pricing it differently. So I think it is justified.
The thing that gives you the most confidence about India and the one risk that you would be most mindful of?
The one blip I'd be a little concerned about is, you talk to LPs around the world and they'll say, I love India, I want to be there, there's just not enough investable opportunity. So it is actually interesting. The industry has become a bit of a barbell. You've got some people on the panel here who are actually out there raising capital, and you have a huge long tail that can't raise any from institutional investors. So that's one thing. In other words, you could end up with India with a highly concentrated manager base that actually represents 60, 70%. It could be a market where you have 6 or 7 managers represent 70% of the market. That's one. I don't call that as a risk. But frankly, it does, it creates a concentration that I think for some managers or some LPs will say, look, I love India, but I can't write big enough checks to enough people. The stuff we love about India, obviously, is, I'd say, on a more lighter note, is the optimism.
I hope we continue to surprise the optimists as we move forward. But many, many thanks, gentlemen, for joining us here today. And thank you very much for your insights and your time. Thank you very much, ladies and gentlemen, for joining us this morning.
Hello, check 1 2 3 4 5 6 7 8 9 10. Hello, check 1 2 3 4 5 6 7 8 9 10. Hello, check 1 2 3 4 5 6 7 8 9 10. Hello, check 1. Hello, check 1. Hello, check. कैंपटो में क्या जिप में